Today we want to talk about something that everyone enjoys talking about, which is cash. and alternatives as well, as far as a tool for investing. So let's start with what we think is a simple one, okay? And that's cash. So Jason, talk to us about cash as far as, I think hopefully everybody has an idea of what cash means, but talk to us about that.
Yeah, so cash doesn't actually mean, physical cash that you have in your fingertips, but in the industry it's called cash equivalents. And so that would be something like monies that are in like a money market or bank reserves or checking or savings account, or really super short term, very safe liquid bonds. So it's basically, it's going to be the safest. Typically, it doesn't fluctuate hardly at all. Actually, it really doesn't fluctuate at all.
Right.
But it's also going to have the lowest yield typically.
Right.
And we've been in an environment for a long time now where interest rates have almost been at zero.
Right.
Where a lot of times cash is paying zero.
Right.
Or 0.01.
And you might see this by your bank statement. Here's my savings account, and it's earning not to
3 cents.
Harp on banks, but you made a whopping dime.
Yeah, exactly.
On your investment.
That's right. So the main risk with cash is not really the risk of it going up and down. It's an inflation risk. So over time, if you'll see here in the next slide, over time, if you look at this little chart here, you see this carton of milk. Back in 1916, a carton of milk cost 9 cents. That same 9 cents in 1966 got a small glass of milk. And in 2017, that 9 cents got you 7 teaspoons of milk. So
it's tablespoons, but
excuse me, tablespoons.
Drink them well.
That's right. So the point is, you lose purchasing power. Okay,
Right.
so your dollar, your cash, is not worth as much as it used to be, because as you can see here in this example, if you had an inflation rate of 3%, but cash was only yielding, or just your savings account was only yielding 1%, your real return was a negative 2%. So you actually lost purchasing power that year.
So another way to say that is, if you hold everything in cash, you're getting poor.
You're getting poor,
because everything is costing more, but this is what you can buy.
That's right.
So as things go up, you're getting effectively more poor. This is one way to look at it, saying, people say, oh, I don't want to take a risk. Well, you as Jason mentioned, you eliminate volatility risk possibly, but then you actually have the risk of not being able to live the way you want to live.
That's right. And if you think about it, sometimes if people go into retirement and they have a lot of cash and it's not being invested, and they live for 30 years in retirement, and you're missing out on that compounding growth over time, and at the same time that inflation is growing faster than your cash, you're becoming poorer and poorer every year.
Right. Now, cash is important in a portfolio, especially for monies that you're going to use in the short term.
That's right.
You don't want to invest money. We talked about this in a previous lesson. You don't want to invest money that you're going to spend in the next 12 months, for example. Typically, you want to have that in cash, because if you need the down payment for a house, then keep it safe, so that you do want to eliminate. And in 1 year, no big deal. You're not losing a lot of purchasing power in that with respect to that.
Same with emergency reserves too.
Right.
So emergency reserves you keep in cash and savings.
That's right.
Yep.
It's because you want that to be guaranteed.
That's
the
right.
purpose of that is not to grow,
safe,
but to be safe and guaranteed.
Right.
So that's cash. Now there is this other area which is pretty broad. We went from something very simple to now something very broad and a little bit more complicated. It's called alternative. Talk to us about that.
Yeah. So in the alternatives we're going to talk about are kind of publicly traded alternatives. So these are investments that you can buy and sell through the stock market. You see here kind of a picture of these, even though they're blue. It's actually, these are gold bars. But
blue gold bars.
A lot of these days, it's a really good thing. They've actually allowed these types of alternatives, like we'll get into a little bit, like gold, for example, or different other commodities and metals, or even real estate. They've made these types of investments where you can invest in those types of investments and through a vehicle that's traded in the stock market, through a stock or through a fund or something like that. So and the reason that you use alternatives is it provides further diversification. We've already talked about stocks, and we've already talked about bonds, and sometimes those have an inverse relationship where one will go up when the other one will go down, and vice versa. Well, alternatives are another way where they're not always going up or down based off stocks or bonds.
Right.
So and if you combine all that together, and we'll discuss this more in the diversification lesson, but you have different non-correlated, they're not related to each other investments. So that if some of them go down, you have another component that goes up.
For the purpose, again, to reiterate what Jason said, the purpose of this lesson, back in the day, if you wanted to invest in gold, you had to buy bricks, bullions, gold bullions.
Or coins.
If you wanted to invest, or coins. If you wanted to invest in oil, you bought barrels.
Right.
Okay. if you wanted to invest in wheat, you actually bought the physical wheat and had to store them.
Yeah.
If you want to invest in real estate, you bought a house or a warehouse, etc., and you're dealing with a physical asset.
Right.
But now with the evolving of markets and of tools, you can invest in all these things without actually having to handle the physical asset,
right.
which has its pros and cons.
Yep.
But one of the pros is that you click a button, you can get rid of it typically a lot easier.
Right.
It's a lot more liquid than actually I have to, hey, will you buy my barrel of oil?
Right.
Than you having to go sell it physically.
That's right. Yep. So the first one we're going to talk about is through real estate. And again, what we're talking about are publicly traded REITs. So a REIT is a real estate investment trust, but you can buy an actual fund that owns a bunch of different real estate inside that fund, and sometimes that may be commercial real estate, maybe industrial real estate, maybe residential real estate. They have different types of REITs, but you can earn money from the price of that real estate going up, the capital appreciation, and also the interest rate from rents.
Right.
Okay, all within a fund, so you can buy or sell it whenever you want. Now there are other REITs out there that are called non-listed REITs. Okay, they're not on an exchange.
Right.
Those aren't as liquid. A lot of times you have to hold those for 5 to 7 years.
Right.
We're not talking about that. We're talking about publicly traded REITs that are liquid. So that's one type of alternative. Another one could be different types of metal or energy or livestock or agriculture. One of the most common ones here that you'll see is like gold. There's a gold fund where you can actually own gold within a fund and get the appreciation if gold goes up or down, which could be a great diversifier. And we'll talk about that in another lesson. Or currency. Sometimes you have like the yen will go up or down, or the dollar will go up and down based off a lot of different factors, the country's interest rates, if they're printing a lot of money or not printing a lot of money, the financial stability of the country, those types of things factor into currencies and them going up and down. You can actually own that as well. That's another type of alternative.
So these are different types of alternatives. Is one better than the other? Not really. It depends.
Yeah.
Okay.
Different conditions.
And so, as we've talked about stocks, we've talked about bonds, and now we're talking about alternatives cash. Which one makes most sense for you? It really depends on what's going on in the particular economy, et cetera, and also your risk tolerance and your goals, which we're going to talk a little bit more in the diversification lesson. But again, our goal here is to really give you a grasp of what these different tools are and instruments, because they're important to be considered if you want to really maximize and optimize your portfolio to help you reach your goals.
That's right.
So thank you for listening, and we look forward to seeing you in the next lesson.